It's beginning to peak out. Where am I going?
Yeah. Well, I think two things I would say. First of all, in a world where we've got these extraordinarily low interest rates and high valuations across asset markets, equities still stack up as being probably the best relative asset class over a 12-month period. We're overweight of equities. I think in the context of the US equity market being relatively flat, which is our view from here, given its higher valuations and probably peak margins, other equity markets are likely to outperform, particularly EM and Europe. We're not looking at very high returns there either, but I think the prospects are for a continuation of a catch-up that we've been seeing in recent months.
Peter, are you baking in any tax reform into that 2600 target? Does it go north if we get significant tax reform, I guess is the question.
Well, I think our expectation is that you'll get some tax reform through next year, but mainly tax cuts, corporation tax cuts. But we would be expecting a relatively moderate move to around 25%. I think that could be supportive, but is broadly expected. It is worth noting that we follow a group of companies with particularly high marginal tax rates. They surged after the election with the expectation that you get a quick and quite substantial tax cut. Since then, they've reversed that outperformance quite sharply. And in the last month or so, they've started to pick up again on a relative basis. So I think the market is getting a little bit more comfortable about the prospects for a tax cut. But I don't think you're going to get major widespread tax reform that of and in itself would drive the market a lot higher. We have high valuations in the market. We have high profits and profit margins, so relatively low returns.
How important are the actions of the president and Congress to your model, to your outlook for U.S. equities? I mean, if they just did nothing, would that change the way you view the future for equities?
If they did nothing on tax reform or there was no tax cut, I think that would be a modest negative. But the most important thing really is the economy, not just the US economy, but the global economy, which together with extraordinarily low interest rates continues to be pretty supportive for equities. I mean, of the around 90% of the countries that we follow are growing above trend at the moment. And this is the first time that we're seeing global growth at around 4.5% since the financial crisis, a very balanced growth. And that, together with the very low rates, is the real key driver, I think, for equities. The problem for the US, in our view, is that rates are likely to rise more than the market is pricing. And valuations are steeper in the US than they are in other markets. And there's a little bit more of a catch-up in profits that you're likely to see in other equity markets, which should give them a bit of an edge as we look forwards over the next few months.